Welcome to Morningstar. I'm Larissa Fernand, and I'm super excited to be talking to Professor Aswath Damodaran from the Stern School of Business at New York University. Professor, good morning, and thank you for being here.
Thank you for having me.
So my first question to you is, as a professor, you are as objective as possible, but as an investor...
Let me pause you right there. I am not objective, but I'm open about my biases. So anybody who ever claims to be objective is right off the top lying. None of us as human beings is ever capable of being objective. All we can do is be open about our biases. I am open about my biases.
Okay, then let's start with your biases. Can you tell me a bias that you have successfully overcome and one that you are combating with right now?
I don't think you ever fully overcome a bias because it's built into you. It's in your DNA. All you can do is be aware of it. So I'll give you an example. I love Apple as a company. I've loved it since 1981 when I bought my first Apple. And I struggle with that love of the company every time I value the company. I can't make it go away. It is there. But one of the things I can do is when I make a choice, I can always step back and say, did I make the choice because I liked Apple as a company, but did I make a choice based on something that's more solid, something based on the numbers? So I think it's an ongoing process. You never get rid of it because it constantly recreates itself.
You were instinctively a left brainer, right? But you managed to merge the story with the numbers. You do that pretty successfully. But has there been a point where you missed a good story because you were way too focused on the numbers?
Oh, I'm sure. And the reverse has also been the case where I've, looked at a story, liked it so much that I've not looked at the numbers carefully enough. So, I think it's not a question of missed a company. I missed a company at a point in time because I was too focused on the numbers. That's really the way to describe it. Because, when you value companies, it's an ongoing exercise. I'll give you an example. I valued Uber every year since 2013. I valued Tesla every year since 2013, which means I can point to a valuation and say, in 2013, when I looked at Tesla, here are the things that I missed by looking at the numbers. I thought of it as a luxury automobile company. But what I was missing was this transition to electric cars that was revolutionizing. It was creating this entry point. And I wish I'd seen it then because I might have bought more shares of Tesla then. But by 2019, I moved on to a different set of issues, which is I was focusing on Tesla as one of the major electric car companies. And so, when you think about making mistakes, it's at a point in time in a company rather than a company across time.
Give me an investing principle that you pretty much adhere to, which you pretty fervently believe in, but a lot of people don't agree with you on that. It's not a very popular stance.
An investing principle, and people disagree with me, it's because they have a different philosophy. That's really at the core of our disagreement. So for instance, when I valued Zomato and I said, I think it's worth 40, 50 rupees per share, I'm not saying it's a bad company or a bad investment based on the cash flows and what I can see. But if you're instinctively a trader, the difference between being an investor and a trader, in investing, you try to value a company, of course, with error, and you try to make judgments based on that value. In trading, you play a much simpler and perhaps in many ways a more honest game, which is you buy at a low price, you sell at a high price, you build on mood and momentum. So when I get disagreements from people, it's more because they are traders. They believe in trading rather than investing, and that's perfectly okay. I'm not going to claim that they're wrong and I'm right because I have no way of knowing, because each brings a very different set of tools to the game. So much of the disagreement I get and the pushback I get is usually from people who come from a different perspective, and I respect it. I back away and say, okay, fine. You make your decisions based on your philosophy. I'm going to drive my decisions based on mine.
How do you ensure that you're not locked in the echo chamber of your mind?
You're never sure. No, that's why this is a process. Now I call, if you're aware of, the 5-step process I use to value companies, I start with the story. Why? Because I'm a number cruncher. I have to start with my weak side. I build on my weak side first. I convert to numbers. I come up with a value. That's step 4. Then in step 5, I call this keeping the feedback loop open. I talk about showing that valuation to people who think least like you. Because we tend to hang out with people who think like us. They go to the same schools, they read the same books, they use the same models, and not surprisingly, we tend to agree with each other all the time. I am lucky enough that I have readers who come from very different backgrounds. They're not finance people, they might not even be in business. So I get feedback from people who don't think like me. And I have to be careful not to shut them out, not to say, look, I know valuation, you don't, because that's a very elitist view, but to listen to the things they say. I think that's the only way you can keep yourself honest is by hanging out with people who don't think like you, because they'll force you to re-examine what you take for granted.
Do you find the silos, if somebody turned to you and say, Professor, are you a value investor? Are you growth? Do you find these silos very restrictive? They paint you into a corner?
No, I don't think it's even the silos. I don't think people, creating these silos, not even sure of what the silos contain. So if you take somebody who calls themselves a value investor, ask them, what does it mean to be a value investor? You know that most value investors have never valued a company in their lives, ever. And I'm talking about 90% of the people who show up at Omaha, they've never actually valued a company. Their idea of value investing is buying stocks with low PE ratios and high dividends. That's not value investing, that's pricing. So often people are not even aware of what they're doing because they're so quick to label themselves as, I listen to Warren Buffett, I've read 3 books on Warren Buffett, therefore I am a value investor. I'm not sure that's a good definition of value investing. No, my definition of value investing is I value something, and if I get a price lower than the value, I'm going to buy that stock. I don't care whether it's a high growth company or a mature company. So my definition of value investing is very different from those silos that you see for value and growth investing. So I wouldn't be so quick to jump into one of those silos because I'm not sure what's in those silos to begin with.
So there's no label that one can assign to you as what type of investor are you?
And the only thing I would use to describe myself is I'm consistent with my own philosophy of what value is, and I invest based on that philosophy. You're welcome to disagree with it, but I try to act consistently with my own. That's all I can do. It's not my job to talk you into using my philosophy, because what business is it of mine? So I value companies for one person and one person alone. That's me. I don't value companies for others. I'm not an equity research analyst. I'm not a portfolio manager. I'm not trying to sell you on an idea because it's not my business. I believe that investors have to take ownership of their own decisions. What that means is you cannot tell me you bought a stock because you heard Jim Cramer promote it on CNBC or because you read about it on Morningstar. You have to buy a stock because you believe that it's a company that's right for you. And that requires investing time and resources and coming up with the philosophy for investing that you're comfortable with.
These monikers that have been assigned to you, Dina Valuation, Valuation Guru, do you find them amusing? Do you find them, how do you view them?
I find them distracting because, in a sense, they make it seem like I know more than I do. I mean, there is no evaluation is simple. It's one equation. There's really nothing there's nothing advanced about valuation. There's nothing sophisticated about valuation. It's pragmatic. So really, to be a dean or a guru in something that's one equation sounds to me like not much to aspire to. And also there are 2 things I worry about when you hear this. One is that people will listen to evaluation or read about evaluation I've done and assume that because I've been given this moniker that somehow I know more about value than they do. In fact, almost every valuation that I do, in addition to telling you what I think the value of a company is, I put out a spreadsheet with no macros, no special features. It's a completely open spreadsheet. And I say, this is my story and my value for the company. Make it yours. What that effectively means is, hey, you don't have to understand every nook and cranny of valuation, but you can disagree with me on my story and say, I don't agree with your story about growth or profitability or reinvestment or risk. But rather than bitching and moaning about how much you dislike my story and my value, which is driving my decision, change them, come up with your value make your decision, and let's agree to disagree. There's nothing wrong with buyers and sellers coexisting at the same time.
Between the spreadsheet and the story, is there any gut feel that comes into play?
I always mistrust my gut. I mean, because in a sense, gut feeling is just your emotional side acting up, right? And we know what emotions do to investing. I mean, we have 40 years of, um, so that doesn't mean that there aren't companies where you go with something because you like that company more. So what we call gut feeling is essentially our biases playing out. So I'm always a little wary about gut feeling, because how can I have a gut feeling about Birkenstock? Let's be clear. I mean, what gut feeling do I have about a shoe company in Germany that's been around 250 years that's going to change the value of the company? I don't have, enough trust in my gut to move around the value of a few $100 million or $1 billion just because my gut feels more comfortable with a higher or lower value.
So investing is all about probabilities, right? So do you believe that there's anything called luck in this entire game?
It's the only thing that matters.
How so?
No? So because if 90% of what happens in the world is outside your control, right? The probabilities cover the 10% that are within your control. So it shows up in two ways. One is you spread your bets. I've never understood people who concentrate their investments in 4 or 5 companies. Because you can have the probabilities in your favor, but luck is such a dominant paradigm in this business that you can be right and go bankrupt being right. So hubris is the biggest enemy of good investing, because hubris is when you say, look, I have worked out the probabilities, they're in my favor, therefore I'm going to load up on these 3 or 4 or one company because I feel I'm going to be right. So luck, in fact, is the dominant paradigm here, and you cannot make it go away, but you can reduce your exposure to it by spreading your bets and being humble, saying, look, I've done my valuation, I've invested in it. All you've done is altered the odds of success from 50% to 52%, not 50 to 95%. And that's what you need to think about here, is you can do everything right, but you cannot control what the world will deliver as surprises.
Can you repeat what you meant by you can go bankrupt being right? Can you emphasize
Well,
that?
often I hear investors, use the word conviction. The word conviction terrifies me, because what it suggests is I feel so sure about this investment that I'm going to take all of my money or most of my money and buy the stock. So you buy the stock, it goes down. You thought it was going to go up. Because you have conviction, you know what you do? You double down. Then you double down again. And before you know it, you've mortgaged your house, you've sold the rest of what you own, you've got all your money in Tesla. And then the call comes because essentially you borrowed money, the borrowing has, and you discover you're bankrupt, you end up in debtor's prison. 10 years later, you might end up being right. The stock you picked might have come back, but you weren't around to see it come back because you put yourself at risk. Don't risk your entire investment portfolio by doubling down and tripling down on bets when they go against you, because sometimes it's good to step back and say, look, I've made my bet. I feel good enough about it that I'm going to let it ride, but I'm not going to double down or triple down on it, because that's a recipe for disaster.
How successful have you been in keeping your ego in check when it comes to investments?
I'd love to say I've kept it in check, but I cannot. Sometimes, I've got to stop and say, you know what, are you getting ahead of yourself? Are you a little too full of yourself? Because, you're always going to get to that point where you feel good about, and that's what I meant by keeping the feedback loop open, is if I hang out with people who have CFAs, guess what? They all pat me on the back and say, this is amazing, because we're all coming out of the same hymn. We're singing the same hymn. We've heard the same sermon. So I think that's why it's so critical that you talk to people who disagree with you. Now, I talk to bankers, I talk to VCs, I talk to founders, I talk to people in very different spheres of business. And that helps me because, sometimes they ask me a question about the fundamentals of finance, and it's healthy for me to have to defend what a cost of capital is, rather than talk about the mechanics of how to compute cost of capital.
You once said that you don't revere the market, you respect the market. Can you just tell me what you meant by that?
When you revere the market, you believe the market's right. You believe in inefficient markets. If you believe in efficient markets, which is a core philosophy by itself, then you stop trying so hard to pick stocks. You pick an index fund and you move on with the rest of your life. You know what? For 90% of people, that might be the healthiest choice. You're a doctor, you're a dentist, you're an engineer. Guess what? You've got a life to live, a job to do. Go do your job. Take your savings, invest in index funds, and move on. Revering markets means markets are always right. When people discover mistakes, it's usually the people who are wrong, not the markets. I am not at that stage. I respect markets. When the market moves, I always stop and ask, what did I miss? Especially if it's a company that I don't know. So if it moves in an unexpected way, I say, what did I miss? And I look for things that I've missed. Respecting markets, it means you never start with the presumption that you're right and the market is wrong. That it's something, and that's why I hate to use the words like bubble. The minute you use the word bubble, you're already telling me that you think the market is full of irrational, shallow people, and you are somehow deeper and more rational than the rest of the market. That's putting yourself on a pedestal, which you really don't deserve. So I respect markets. I always start and ask the question, what is it that markets see that I'm not seeing? And perhaps I'll come to the conclusion that markets are wrong, but that should be your final conclusion.
What is it that you respect in people? And when I say people, I mean three categories. Probably your students in your personal life, or in a promoter or a manager. What insights gets respect out of you?
Humility. It's my biggest, I think people who are willing to tell you that there are things they don't know that could hurt them, that could hurt their businesses. That to me, I do a whole session on smart money. You know what? I've been looking for smart money, the smart in smart money for 40 years. I still haven't found it. Now, I've been told hedge funds are smart money, venture capital, and every time I look deeper, it doesn't look that smart. No. So I have a different categorization of investors into humble money and arrogant money. I will not put $1 of my savings with arrogant money. I'll give you an example of arrogant money. Master Son, founder, CEO of SoftBank, viewed as a legendary investor, at least in 2019. You know what gave away the fact that that arrogance is, he's Japanese. You can never admit to being arrogant when you're Japanese. You got to go through the humility act a lot, right? So he's a humbragger. You know what a humbragger is? You try to act humble while you're bragging. Okay. So, and Master Son, of course, had a 300-year plan. Who makes 300-year plans? Only people who have delusions of being God make 300-year plans. So when WeWork fell apart, my first reaction was, how can you trust two arrogant people in a room? Adam Newman, CEO of WeWork, and Master Son, CEO of SoftBank, get together in a room. What comes out of that room? It's going to be a recipe for disaster. So to me, humility is the starting point. And of course, then I look for, do you have the good sense to know how to build a business? A lot of founders are great with ideas, but converting an idea into a business requires work. Are you willing to put in the hard work? And I think you need people around you that you're willing to delegate. Because if you try to run everything by yourself, people who are control freaks are going to get themselves into trouble, both in terms of financial trouble as well as in terms of health, because you're running yourself into the ground. So those are the things I would look for in a person.
And what trait would just repulse you, that you just run away?
Arrogance. Anybody who claims, I know the answer, I am right, that sets off. I very seldom, disagree with vehemence, but when I run into somebody who claims to have the high ground, arrogance, and I'll add the one other feature. Arrogance and the notion that you're on the moral high ground. If you combine those two, you have the ultimate combination of, I mean, that is truly repulsive when those two things come together.
Yeah, you find a lot of that on social media.
Yeah. And anytime you believe you're in the right and the other side in the wrong, and you combine that with arrogance, then, you're off to the races then.
As a professor, what part of your job do you find exhilarating and what do you find challenging?
I'm a teacher. I'm not a professor. I don't call myself a professor. I've hated it when people call me Dr. Damodaran. I mean, let's reserve the doctors for people who actually have medical degrees. You don't want me around when you have a heart attack. Trust me. I am not the person you want to go to. So this notion that somehow once you get a PhD, you should have a doctor in front of your name, I've never understood that fixation. I'm a teacher. I know I have a title as a professor, but that's the title I use to be able to teach in a classroom. So that's really why I do what I do. I'm a teacher, first and foremost. Everything I'll do is secondary to that mission. So I'm not an academic, I'm not a researcher, I'm not a professor. Teaching is what makes me tick.
Okay. And what part of it do you find challenging? None, nothing. You
No,
love
I mean, it's a passion, right? Teaching is like, teaching is really not a job. And I've told people, look, if I wasn't teaching valuation or corporate finance, I'd be teaching physics or chemistry or algebra at high school. If I couldn't do that, I'd teach math to fifth grade. Teaching is what I want to do. What I end up teaching happens to be, what I enjoy right now. But teaching is really what drives me.
Okay. And my final question to you is what gives you sleepless nights?
My kids, my family. It's not markets, it's not stocks. In fact, with investing, I tell people they need to pass the sleep test. You know what the sleep test is? If you lie awake at night wondering what your portfolio is doing, you've already failed the sleep test. It's usually an indicator that there are things in your portfolio that don't belong there. I've never had a sleepless night because of a valuation I've done. I've never had a sleepless night because of a company that I'm valuing. I've had sleepless nights about worries about, somebody's health in my family. So it's really reserve your sleepless nights for the things that truly matter in your life. It shouldn't be business, it shouldn't be investing, it should not be a portfolio.
That was fantastic. And I think we can end on that note. Professor, a million thanks. Okay, teacher, a million thanks for joining me today.
Thank you.
I'm Larissa for Morningstar. Thank you for watching.